My name is Amyn Mussa, and I head our projects and infrastructure practice at Anjarwalla in Khanna. The purpose of this session today is to discuss public-private partnerships, especially given the increasing importance we are seeing being placed by many governments, including the Kenyan government, on financing infrastructure through public-private partnerships. We'll actually look at very briefly look at project finance and understand how project finance is now dealt with. We will look at this concept in much more detail in our later trainings and understand how we structure financing. On PPP, financing by and large comes from two parties: the equity parties that form the sponsors and the developers, and the debt financiers who provide various forms of loans, senior lending, mezzanine financing, and typically these are ring-fenced through the special purpose vehicle, and therefore we refer to this as non-recourse project finance. And we will understand these structures in much more detail in the later stages of this training program. So many times we are asked, what is the difference between project finance and corporate finance? Isn't this, in fact, the same thing? There's a fundamental difference actually between the two. And typically project finance is what is used to structure transactions in the infrastructure and the PPP space. And the reason for that is these tend to be non-recourse transactions. What do I mean by that? In these situations, if the project company is unable to pay, the lenders have no recourse to the sponsors and the developers. Now, there may be some exceptions to the rule whereby sponsors and developers are required to provide what we call equity support. But typically that equity support is not a full-blown guarantee of the obligations of the project company. And in those situations, that's what we call non-recourse finance. And because it is non-recourse, the lenders and the equity providers look at the contractual structure in great detail. Because lenders have no recourse ultimately to equity or the sponsors, they need to ensure that the risk allocation package works very well, that the contractual documents are robust and deal with the various risk allocation structures, because frankly, if something goes wrong, they have no recourse, or they have very limited recourse to the sponsors of the project. On a corporate finance deal, it is not unusual for full-blown corporate guarantees, bank guarantees, and other collateral to be provided to secure the lenders. Secondly, as I had explained earlier, the project company typically in an infrastructure project is a special purpose vehicle. In other words, a new company that has been incorporated solely to undertake one project. In other words, their balance sheet is frankly nominal at that stage. Unlike an operating company that will already have cash flows, that will already have assets, that will already have a strong balance sheet that a lender can rely on, typically the lenders will also not be able to rely on the balance sheet of the project company. Hence, once again, the importance of the structure and the contractual arrangements of this transaction. There are a number of other differences around the security package, the fees, the tenor. Project finance deals typically have a much longer loan repayment period than a corporate finance. And so, because infrastructure and PPP projects typically use non-recourse project finance, the robustness of the structure, the robustness of the risk allocation, the robustness of the contracts is fundamental to get lenders comfortable to lend money on a non-recourse project finance basis. And so, as we explained earlier, the ecosystem of the various counterparties to a project finance transaction will involve, firstly, your project company that is typically owned by the sponsors and the shareholders. They will have contracts with government, with suppliers, with contractors, with operators, and very importantly, with all the lenders and the various financing parties. To end this discussion, I thought it'd be useful to show you a live example of a transaction that we did many years ago acting for the sponsors. And I'm sure many of you are aware of and know of the Lake Turkana wind power project, a 300 megawatt wind project that has been constructed and is currently operating in Marsabit, one of the first renewable projects in Kenya, and a highly complex project given its size, given its scale, given its remoteness, and for other reasons. And if you look at this contract structure that we have on the screen, you can get a sense of how many different contracts we had to deal with as the project company, how many different counterparties we had to deal with, and how we tried to ensure that these various contracts talk to each other in a suitable way, and that the lenders who sit on top of the slide, lenders like African Development Bank, Proparco, FMO, would ultimately get comfortable with the risk allocation structure and the contracting package. So you see government contracts in relation to the power purchase agreement, the letter of support. You see various construction contracts. So in this case, a very unique structure of construction was used. Instead of having a single EPC contract, the project company had multiple EPC contracts with various parties. Further to that, you had an ancillary project that was being developed by the government, and that was the development and the construction of the transmission line that was almost 400 kilometers long. And so you had two concurrent projects that had to work together. And that is part of the uniqueness, in my view, of this project. But I hope this pictorial representation gives you some idea of how complex these transactions can be. In addition to that, we have also put forward a pictorial representation of another project that we acted on. This is a heavy fuel oil project developed by Triumph Power. Actually, the reason we have this representation is to explain and show what we started to see at the very beginning. At that time, this was many years ago, what we call the Chinese phenomenon to infrastructure projects. What do I mean by that? So if you look at the transaction structure of this project, in those days, this was unique in some respects from a sub-Saharan Africa perspective. And in fact, in some respects, it was unique from a global perspective. And like I said, I think this was one of the very first projects where you saw Chinese involvement in terms of lending and construction to infrastructure and PPP projects. It was typically unheard of for Chinese contractors to be involved in PPP projects. They may have been involved in traditional procurement projects, but in East Africa, generally, traditional contractors from Europe, America, etc. were used. This was certainly, in my view, one of the first in East Africa in having a Chinese contractor undertake a construction contract under a PPP arrangement. Since then, obviously, we have seen a huge number of contractors get involved also in PPP projects. In addition to that, this project was unique in that it was probably one of the first times in sub-Saharan Africa that the debt financing came from commercial banks, and there was no DFI lending. By DFI, I mean development financial institutions like African Development Bank, CDC, IFC, etc. These are the traditional lenders of money to infrastructure projects. They still constitute a majority of the funding that comes into infrastructure projects, but this was the first time, I believe, in sub-Saharan Africa that an infrastructure project was fully funded by commercial bank money, and more importantly, by a Chinese commercial bank, ICBC in this case. What was also unique about this project is, at that time, together with a couple of other projects that were being developed, in East Africa, the MEGA political risk insurance guarantee was developed with the World Bank, and an IDA partial risk guarantee was also developed with the World Bank. In addition to these products being fairly unique at that time, it is my understanding that it was the first time on a global basis that a Chinese commercial bank, ICBC, received the benefit of a World Bank guarantee. And therefore, like I said, I think this project shows how the infrastructure space has changed so dramatically with new entrants to the markets. Now, not only just from China, but also from other countries like Turkey, countries in Latin America, etc. And so we see this space evolving further and further as new and more interesting players bring their input into structuring these very complex arrangements, but that allow countries to benefit and its citizens to benefit if they are well structured and they provide value for money to the country and to the citizens of that country. I believe that I have actually now come to the end of my presentation. And like I said earlier, we will have, following this presentation over the course of several months, many more detailed presentations around the specific aspects of PPPs. But I hope you found this introductory session helpful to give you a basic understanding of what we mean by PPP transactions and what is involved in a general sense of putting together these transactions.
If you haven't subscribed to the ALN Academy's YouTube channel, this is the perfect opportunity. Click on the subscribe button and notifications button. We will continue to upload much more content on rule of law.